Good afternoon, everybody. You are here listening to Howard Greenberg and the legend, the disciple of trend, Charlie Moon, and our Dips to Rips podcast coming to you today, FOMC Day. Charlie, how you doing, buddy? You feeling okay?
I'm a little tired running these cracks back and forth, right? Up and down.
Yeah,
what a day, man.
It is.
You know, with the markets, like I was telling the room specifically to expect new lows and new highs. And we sure got it. We went from lows to highs to new lows and they finish off of a meltdown. But your market held up better than stocks. What do you think about that, man?
I'm shocked. I mean, I, as you know, have been fairly bearish in general, but I was fairly positive going into today. Quite honestly, we went long. It's about even right now for us, maybe down a few pennies in the trade because we got in about 12 o'clock or so. We got into the long position. But yeah, not as much volatility as we've expected. I did all this charting and looking at the last 3 times Powell spoke and how far did we move and what time of the day, 24 hours, like you said, lower day, higher day. I had it all broken out. And it did nothing to help me. As I said to the room, because the one thing we can't have is no volatility. You know what I mean?
Right.
It's like you said, we started at 19.1, 19.2, jumped up to 19.750, down to 18.8, back up to 19.5, and now we're back at 18.9. So, there isn't really a whole bunch of movement from where we started at 9 a.m.
Yeah, I guess it was like a rinse cycle with your laundry. I mean, the truth of the matter is that there is a bit of a divergence today, which is actually a pleasant surprise to see, and it's probably going to benefit you much greater than it would benefit a person like me that focuses on equities. Do you think there's a standout reason why crypto held up better? Because with equities, Powell respectfully really didn't sound overly dovish, wasn't overly hawkish, but he certainly didn't alleviate any concerns. He specifically talked about real estate needing a correction to balance out. He talked about, the push. Well, he talked about specifically the push for interest rate hikes to be somewhere between 100 basis point to 125 basis point. And that meant, respectfully, that upper tier is where the market would probably be caught off guard because the market was pricing in no more than a 25 basis point hike in December. But, we could still see it balance out for equities. However, I think that this is now cause and effect where we could see actually equities coming back down to potentially revisit those 52-week lows here. Whereas it looks like at least with BTC and Ethereum that they're going to just try and balance it out and hold in the upper range off of those lows and maybe even rally. I mean, do you see a possibility of crypto making a rally? Because I don't really see it in stocks right now. I don't see that being a cause and effect here.
I mean, DXY has me really worried. We got over 111 today, and that I think is also weighing on us. So while I am cautiously optimistic, I call it the Fed 1.5 rule. It usually takes about a day and a half to really see the full effect of what's going on. Usually going into Friday, you sort of get that the volatility plays out and you get your directional move. Right. I still think that directional move could be upward. But I think part of it is, crypto is beat up a little bit worse since the merge. As people unwound their position there, it took down the price. Was just a cause and effect. We had a huge amount. I have been pointing out open interest up around 33 billion is now back down around 27. It had a pretty big pullback, and most of that was just people unwinding their hedges in case the merge blew up one way or the other. That is,
you talked about the hedge, right?
Yeah. Oh, yeah. Yeah. And you see it in the funding rate. I mean, funding rate went from all-time lows. They're right back at neutral now. So remember how I showed you that?
Yeah.
You were looking at it last week.
Yeah.
Now that's back right to neutral, back at zero, basically.
So, like, for me, if the cause and effect of the stock market is going to be driven by the FOMC here in the near term, we kind of go back to what history says, right? Scott pointed out in our group chat earlier what the 3-day average has been like in the SPY after an FOMC meeting announcement, and you posted up a lot of the same data with BTC as well on what the effects of Powell speaking. But what we normally see historically is that the markets tend to love when Jerome Powell speaks, so they rise up the markets, and we see a really nice rally. But today, the market really let itself go right towards the very end of his speech. The key factor was the housing correction information that he started speaking on, and what his views on what if we're going to be in a recession. He basically said don't know the odds of a recession, so he didn't really stem fears of a recession in any effect in that way. And there was some red line in the FOMC announcement. For those that don't know, basically the FOMC, when they released their statement from their meeting, it's a copy and paste. It's a literal copy and paste from their previous meeting and announcement. So what red line means is that they cross out certain words and replace it with others, or it's a change in language, or it's a deviation from stance. And there was only some key comments that they had said in terms of the red line here. I'm just going to share my screen really quick. You can see this here.
I mean, my takeaway, Charlie, just was on a bigger level was that, now it's 4.4%. Looks like the terminal rate that they are targeting.
Yeah.
And that is, and that is, up from 4. So
it's technically, if we're going to put it in that light, we went from 3.5 and then we went to 4 in the last meeting, and now we're at 4.4, right? So we're seeing this obvious progression. And that's funny you mentioned that, because that's exactly where one of the key red lines were. Like, if we take a look, Howard, and you look at their statement, pretty much it was a copy and paste of everything that was said before. But they said instead of saying recent indicators of spending and production have softened, nevertheless, job, right? They actually crossed out and said recent indicators point to modest growth in spending and production. Job gains have been robust overall. And then they snuck in the point of being at 2.25 to 3. They changed that to 3 to 4%. And that's a big difference. And that's kind of why we leak towards the end, because again, one of the partial hawkish statements that Powell was saying here was correction in the housing market to balance out. Well, we don't know, it wasn't like we're not going to go into a recession. It was, I don't know the odds. It's very possible we could go into a recession. And, the market clearly didn't like that. And now this is where we get into the historical values of what expectations are, right? Normally we rally. We did see the rally when Powell came on. The market dumped during the announcement, rally during his initial Q&A. And then we started leaking at the very end. And as it wrapped up, the market just went down, made new lows, and then slowed off. So normally in this moment, I would have been like, yeah, markets rebounded and held up when Jerome Powell spoke. Historically, the following day after FOMC announcements, the market tends to move lower. That's what the normal assessment was or is in relation and relative to what, the patternized trading or schedulized trading has been. And there's a deviation to that. So there's a possibility that the markets may try and rally, but I think we're going to actually gap down pretty bad, probably somewhere in the tune of over 1%, and then try and rally and still probably finish the day in the red. Gunloch said that the FOMC announcement was hawkish, said the Fed should slow down rate hikes because they're pushing economy into recession. Now we've heard all these freaking talking heads say, we need to hike rates. We need to hike rates. And now they're saying, whoa, slow it down here.
Yeah, 1 minute's pull the Band-Aid. We need it off. They've been trailing on everything. Now it's that they're going to overcorrect. Yeah, we either don't move fast enough. We move too fast. They can't make up their minds one way or the other there. I think that's part of the uneasiness in the market also myself, quite honestly. I think most people are like, well, what is it? I mean, this morning I was reading, Bloomberg and CNBC and CoinDesk and all the different experts out there sort of give their view of what was coming. And they all said the same thing. It's 75 points and it's this. And that's pretty much what it was. But not one of them agreed on what the heck the result was going to be. And I don't think anyone got it right. Right. We're gonna absolutely skyrocket up, look like we're taking off. Then we're gonna absolutely skyrocket down, just collapse to new lows. Then we didn't make it all the way to new highs on Bitcoin. We did on some of the alts. And then we're going to get back to all-time lows, the lows of the day. So we went from, a mid-tier spot in between the middle of our trading range for the day to top of range, bottom of range, top of range, back to bottom of range, all within the last 3 hours or 2 hours, of the day.
And the inverted curve is steepening, by the way, which means that they're starting to fan. And when they start to fan, that's usually a strong indication that the market is pricing in a recession. That's the absolute truth. That's historically how it has.
They will change that tomorrow, Charlie. Come on.
I bet. I'm sure they will. We're now Elizabeth Warren came out and
she's all mad.
Yeah, talking.
She's always mad, Charlie.
I know you didn't get to see this, and I don't mean to quickly.
I've been watching it. That's what I was watching when you sent me the link for this.
What, the big bankers talking?
Yeah.
Okay. Did you see that Jamie Dimon told Congress members that cryptocurrencies are Ponzi schemes, but he backed stable coins?
Yeah. I just give up with him.
It's more like I think what Jamie Dimon is trying to do is truly pivot towards a crypto asset that's going to be backed and created by JP Morgan itself. And who the biggest one. Well, no, you're right. But as in like being one of the standards, right?
Oh, yeah. They want to make a stable coin. Absolutely. He's going to talk down the market. That was something I mentioned to you. I wanted to talk about today that I've noticed is there is absolutely seems to be a concerted effort by mainstream media, Bloomberg being the first one that I noticed it today on, attacking the native crypto exchanges and infrastructure, talking about the inefficiencies, maybe front running by Alameda and FTX was sort of the whole gist of an article. Amazing how that came out the day after EDX, which is the exchange basically that's being funded by Citadel and Virtu and Schwab and Fidelity and all their little friends.
Right.
And where the guy went on CNBC, their CEO, and on CoinDesk, and on both of them talked about, compliant, trusted intermediaries following what the current broker dealer, market maker, exchange, silos that there supposedly is in the regulated world. But as it was brought up by almost everybody, Ernie really did a good job of blasting the bankers and saying this thing's a sham because all we do is grandstand and bring you guys back in. We find you in the thousands and you walk away with the billions and you just rinse and repeat the same, things. And it's like when Citadel says that. So Citadel, Securities and Ken Griffin saying, hey, we're going to have, crypto is no good because there's gray areas between the broker dealer and the market maker and maybe the exchange. Well, there are 3 different companies that do that Citadel has Citadel Securities, which is a trading brokerage firm.
Right.
They have Citadel, the market maker.
Right.
And they have Citadel, that's a broker dealer.
Right, exactly.
They just have 3 separate CEOs. If you don't think that they have the same intrinsic issues and that it's been proven through SEC, investigations, enforcements and the such, that they take advantage of these synergies already.
Right. Because it's not like they're buying order flow to help their HFT firms, which are causing and creating, abnormal pricing movement that they could take advantage of. And in essence, they're arbitraging the scale of timing of entries, right? In and out being quicker than everybody else, which they're probably already trying to arbitrage or have arbitraged in multiple exchanges in crypto under the gig guys or gees or whatever of other entities and assets, or
right.
maybe
They just had
shared
Jump Capital doing it. They
Yeah,
just had
and-
Jump Capital and other trading desks that they dealt with that were doing that at their behest. Now they think there's a couple of extra pennies if they do it themselves.
Do you support the idea of having every exchange running on the same database so that it is consistent?
I do. I do think that is what you need to see, that we need to see like FTX, Binance, Gemini, Coinbase have a central order book of some sort.
Right.
It does, and I do agree somewhat to what Ken Griffin said, and that is that you're going to see two sets of traders. You're going to see people who only want to use their Schwab account to invest in crypto, and they'll be happy with the connection that they're given through Citadel and this combination. And then you'll have the crypto-centric people that want to participate in DeFi and do these things that are going to use the crypto native companies. And you're going to have both, intersections of both. Because there's no way to outlaw or to ban all of DeFi and, a decentralized system.
Right.
But what you can do is there'll be an opt-in. You know what I mean? Is you'll either opt into Citadel in a order book, and hopefully at that point you would see Coinbase. What I do think is you're going to see whether it's the CFTC or the SEC that gets put in charge of exchanges. One of them is going to bring everybody in. And one of the things they should absolutely be talking about is using a central order book between all of those regulated exchanges that want to operate in the U.S. and get regulated in the U.S. They should do that. CFTC.
Do you think that's going to be a big point of emphasis for adoption? Like, I also think
yes.
and then partially we got to get rid of the promising of, egregious, returns for staking coins. I think that those are like two major hurdles because, like you said, that's kind of what the SEC was looking into in terms of Ethereum. Right. And basically the entire Ethereum market possibly catching heat from the SEC because of the promising returns for staking. Do you think that's going to be a hurdle? And then the adoption of the central book?
I don't like to get into which coin does what. I think that Ethereum is sufficiently decentralized that even though it doesn't hit all of the parts of the Howey test. So they'll point to one or two features that it does have. And what it doesn't have is those stakers act individually. So as a staker, I don't do something with Charlie Moon to decide whether or not we're staking today or unstaking or
sure.
It is all individually decided and done. So I don't think it hits all of the components required. So I don't think Ethereum is a security. But regardless if they're securities or not, you are correct. Adoption only comes through regulation. For a lot of people, because again, it's like my dad. My dad doesn't want to even sign up with Coinbase. He wants to be able to use his Schwab account. And if he can buy Bitcoin through his Schwab account on the same app, then he'll do it. You know what I mean? And that whatever, tax software he uses, like Tax Cut, as long as that works with it, that's where adoption really will come in the US. Remember, the rest of the world, there aren't banks on every corner. There aren't access to liquidity. There isn't access to ATMs. There is a lot of times large land distances between, even individuals, especially farmers in sub-Saharan, Africa or, migrant workers and the like. So, crypto has got a lot of different parts of adoption. As I've talked about, adoption is going to come in the way that Bitcoin maximalists talk about it in a game theory way, starting in the smaller, least developed nations that have the most to gain or the most to lose by not adopting crypto. If you're Argentina and you're seeing 50, 60% inflation, that's why they're buying all these stable coins right now. The amount of stable coins being bought in Latin America is huge because they can hedge. Can't buy US dollars legally, but I can buy USDC. You know what I mean? So
I just want to share this really quick. I just saw this tweet. Hey, So there's a new filing out there for a 2x leveraged AMC ETF, along with the 2x leveraged GME, plus MSTR, Tilray, Hood, BYND. These are all coming out. And this is the same group, by the way, that filed for the inverse, where you could buy an ETF to short these. This, like, you know, they have one for Tesla. It's called Tesla Q. But I find this extremely interesting that now this is going to be out there, and we're going to see, in terms of value, right, in terms of demand, where retail really is on these names and these ETFs versus where.
The problem that, that hopefully the apes understand is, but by buying that, they're not buying the underlying asset. They're buying something that tracks that asset as a derivative.
Well, if it's an ETF, I believe that they actually have to take on so if more money comes in on the inverse, the money actually has to flow for a short and vice versa. I actually think that's the case, because that's what happens with SARK, ARKK, along with Tesla and Tesla Q.
Okay, because CME is not like that with their futures. You know what I mean? They're cash settled derivatives a lot of times.
Yeah, so I would have to look into this filing and see the prospectus a little bit closer. But as far as I am in terms of these inverses, like, this is going to be nuts, because if that 2x leverage is actually in play, that means that money has to reflow back into those equities on the buy side or sell side, depending on which ETF is catching the actual bid itself. But I just find it funny. It's like there's one for MSTR, Coin, GME, AMC, PTON, Tilray, NKLA, Hood, BYND, and Penn, which obviously are all the Reddit stocks. And now they have it on the buy side for all those names as well. MSTR. This is crazy, man. I don't know what this market is starting to turn into.
And then they talk about crypto being too volatile, or that, the threat. I mean, so there's my perfect example, Charlie. Like, why are those needed? Just because somebody.
It's all about demand and making money.
Yeah, absolutely. But it's not good for the industry.
Yeah. So, this is kind of getting to that point where we're now at 2022 seeing record historical volume for options, and we're seeing haircuts for the underlying, and we're just seeing this natural gravitation towards prospectively what we would say risk, right? Because options only give you the right to buy the underlying. And because of expiry, aka expiration, theta and decay, risk is very prominent, right? Because we talk about what you were saying earlier with intrinsic versus extrinsic. And, it's one thing to buy and hold a stock. Certainly you have time on your side for it to correct itself and work. But with options, you don't have that. And that's, people that don't know options or how to trade options. Well, they don't know how to trade options. People aren't realizing they're pulling $100 bills out of their wallet and literally setting it on fire with the big lighter, because they're just letting it expire worthless instead of mitigating or managing or looking to roll over, et cetera. They just don't know. They just hold and pray. And, that it's not comical in a sense. It actually makes my job way more difficult, because now we're, my position, instead of, and part of my job obviously is helping people understand risk and risk management. But it becomes a point where a lot of people don't tell me until it's very late, or it's too late. Yeah. And, they're expecting me to put out the fire, and I just don't have that capability, because we're talking about options now. So this is, this is only going to kind of lead to more leverage, because if we create these assets, then they're going to, eventually find a market for demand of those options. And then now we have these leveraged assets getting leveraged even more with the options market.
I mean, they always claim that, the addition of all this stuff, because people can hedge and run sophisticated, strategies, make it a more established and secure market. But I don't buy it. I just don't buy it. I think it adds more volatility, because 90% of retail traders get liquidated on these things and don't understand because they don't understand what they just did,
or they get margin called and not know why they're getting margin called.
Or
what's crazy is that on the flip side, if
auto deleverage, so
but on the flip side, Howard, if like let's say crypto funds were trying to make it safer, et cetera, everybody's saying no, you're making it much riskier. And it's like the same argument is acceptable in equities, but not acceptable in crypto. And that's where you and I always meet and say the exact same thing. This is total BS. And there's a reason why that, obviously, or there's a reason why the chatter always comes from the same source or from the same core, right? Yeah. And, I don't know what to think about this, but I don't foresee this as really truly being something that's going to end in a positive light, in my opinion. Maybe that they're saying this gives people that are drowning in AMC and GME a potential hedge.
That's what they'll say.
Yeah, but it's really not true.
No, because they're not hedging that. The one that is Citadel. You know what I mean? Again, market makers that understand it to do sophisticated trading are the ones that figure that out, or whales, because again, usually you're only selling you're only selling options against your stuff or hedging, usually if you have over 100 shares, right? Because that's a block. And, so there's that. Yeah, I agree with you. It's part of it is where, like Sam Bankman-Fried has been in front of the Department of Agriculture or the Agriculture Committee in Senate, because that's who oversees the CFTC, about the way that margin's done within crypto.
Yeah.
And that actually is the way it should be done in equities. It's a trade, an individual trade basis. It's cash settled immediately. There is no +2. You don't have any $25,000 day trading rule. If I want to buy the SPY, sell the SPY, buy the SPY, sell the SPY, in theory, if I want to do that with Bitcoin 40 times a day, I can do that because each trade is looked at as an individual trade. And the world of equities, it's literally, what is your life savings? What have you done the last 20 years? Decides whether or not you are allowed to, buy SPY puts and play SPY calls and SPY puts throughout the day.
And you talk about cash settlement. That's a big thing because, there's been plenty of times. There was a time when I was actually on the floor with Scott at the CBOE, and him and I were just doing a TV interview together, but it was a really ugly day. And exchange rules are way different. Your cash settlement is at the close. And I just remember there was a row of people at desks with all these phones, and they're making these calls and constantly making these calls. And we just briefly hear it, but Scott pointed to me. He's like, that's the margin desk. These guys are calling people because they're looking for cash, and if they don't get it, they're going to take it. And he's like, traders got wiped out today because if these guys are busy on the phone, that means that there's a lot of money that needs to be settled. And most of these guys won't be able to have it. They're avoiding those calls. So that means that they're going to be going into there's exchange rules. I don't know if it's tied directly to the banks or their accounts or whatever it is, but this is where people will lose everything.
Yeah, they have
hate to see those moments.
Those things that is supposed to cover for that insurance and so forth. But that's
not how floor traders are, though,
right.
Man.
If it's a trade in crypto, it does it per trade. So not even at the end of the day, it's when your trade liquidates, it auto liquidates, and it liquidates in profit. It has a percentage above bankruptcy that it does it at, so that again, you don't have the risk of someone going underwater. So it doesn't allow you to go into margin.
Right.
You don't ever have to worry about that because it would sell it. Basically, if your liquidation price, if your break even or bankruptcy price is if Bitcoin hits 18,000, then at 18,400, it sells your position and closes you out. So that everybody gets paid and there's no threat of any kind of loss. And it does it per trade. So again, it doesn't have to, worry about how much money you have in 30 other trades. They're all individual.
Yeah, but that's because everything is automated and through a process of, safeguarded systems. Remember, on the floor, everything's a paper trade that's executed and turned in and then, the runners run and then it's cleared. But
do they do it that way though? Because when I was watching, we were there, because I had never been till just
the system may be different now. They may have automated.
So they were running off iPads. So it was getting done on like the guy was, someone was.
But that doesn't mean the paper system is out, because they still have those trading cards. Again, dude, if you saw it back in the day, people would write trades and
I've seen what it is. What I'm saying
literally be able to throw the card across the pit to their clerk and have it run.
When we were just at it, they were doing everything. I was surprised that I actually taped it. The guys from James Street were right in front of me, and I was watching them do it, and they were using their iPads to do it. They, the trade. He kept on telling them, "You got to accept the trade. You got to accept the trade." And then he would go
through the iPad. Don't doubt. Yeah. I don't doubt that the new floor and the new system integrated to being electronic. Yeah. But again, the last time I was on the floor, I still saw paper trading.
Right.
And as far as margin calling goes,
just think about what Scott used to do.
You got to remember, you got to remember that these firms work on margin as well. And every single firm out there uses leverage. That's why there's a market on close balance on the buy side or sell side. And that settlement is going to be due. And by the close, they're expecting cash to be settled. And if it's not, they're coming for your money. And once they come for your money, you're not allowed to trade. It's not that there's a risk tolerance threshold. There's a maximum they may allow them to go into margin, but they're still expecting settlement by the end of the day. And whether it's automated or not, it's like, okay, well, you don't have it in your account, get it out of your bank. You don't have it in your bank, we're coming for your house. We're coming for that money. You're going to pay it one way or the other. We forget that floor traders trade on these exchanges, but these exchanges are businesses. They're publicly traded companies, right? You could trade NDAC, NDAQ, you could trade Intercontinental Exchange, ICE. They're all exchanges that are ready to go. And if you're wondering why all this funny business takes place with equities, or why JP Morgan and Morgan Stanley and Citibank are allowed to constantly break the rules and not face repercussions, it's the cost of business. If they get audited and then they'll get fined $2 million every single month for breaking the rules, that's okay, because they're profiting $10, $20, $50 from that firm, from that pit, from that team. And why do the exchanges allow it and constantly allow it? Well, if your biggest client, right, that counts for 80% of your revenue per month, what are you going to do? Kick them out?
Nope.
Not at all. Not unless you want to lose your business and, see the bottom line drop, and then essentially, obviously eventually go out of business. That's the kind of the cause and effect rule. But the margining system and being automated in those trades probably cleaned up the logistical issues of getting these trades recorded. But I still think the margin issue is still a problem, because it's very old school in that fashion, as opposed to what you were talking about, where everything is automated based on cash on hand and balance. I don't know what this is going to hold for us in the near term with automation, because we obviously know that there's no floor pits for crypto, right? Outside of futures at the CME, everything's been automated, and we've seen from basically the 90s on, seen this big transition to electronic trading. And, if we look at it from the equity side, it's changed the game. It's brought in a ton more liquidity. And I guess if we see more liquidity in crypto, do you think that's going to be good or bad? Do you think that'll be good for?
No, it's going to definitely be good. Cost of trades will go down. You'll be able to do more things. Getting exchanges regulated so that they can offer, what's reasonable for margin, trading, or for leverage trading, as opposed to it being sort of the Wild West where everybody goes offshore and there's still 100x places. Those are the things that you want to see come that are going to make the market more robust for it, Yeah. And, that's what you see. And the other part is I think what comes also is, it's the old joke about the drug dealer. The first taste is free. So someone starts playing around with Bitcoin, and Bitcoin goes from 20 to 40. All of a sudden, they're pretty hooked on crypto. And now they want to try the other alts, and they want to see what DeFi is about, and they want to see these other things. And so they might start out with EDX and Citadel, but then they end up on Uniswap and Aave, and you end up diving in. That's the other part of it. We got to get them. Their first taste is free through EDX and Schwab. Because I can't tell you the amount of traders just in my our clients that say, hey, the only thing I traded before I came into your room was I bought some Dogecoin on Robinhood. But hey, it went up and I did good and I wanted to get into it. I don't care how you get into crypto. You know what I mean? Is whatever your gateway drug is there, feel free to imbibe. But then, then we've got you, then hopefully you become a convert of the fact that it is settled easily, that you can get on chain data very easily. It's accessible 24/7, which people like, and you go from there.
Hey, Howard, do me a favor. Remind me. Remember I talked to you about the Doge whale that I know? Yeah. So he's getting into NFTs now. Remind me to show you his project. His NFTs are pretty insane. And I think he's going to get the Doge army getting involved, but he's doing it under a surname. So I'm not saying who he is. Right. And I'll only mention his surname, but I want you to take a look at it because it's pretty freaking awesome. And if you could get any hype, we could get it in early. Anyways, I also want to give a shout out. Tipping Point, guys, Tipping Point Brewing Company. We're not sponsored by them. It's one of our clients down in Georgia. So if you're in Blue Ridge, Georgia, go give it a visit. He opened this brewery with profits he's been making with me since he's been a client of Prosper. So that's a big shout out to my man Ward. It's not like he's doing it on my signals. It's just that he learned how to trade really well, was very disciplined, and he's been constantly working it while he has a full-time business, a full-time job. My man grinds it out. And now, you give an Irishman a brewery. I mean, is he in heaven? That's the question. This is his brewery. He sent me some swag for my birthday. I just want to give him a shout. Howard, let's go to Atlanta and check it out with Michael, and then we can get lit. I love it. All right. Sounds good. Howard, I think there's something else you want to talk about. Refresh me. Is there anything that I'm missing out here?
We hit it, EDX and the compliance and the other issues.
I want to say, looking forward here, guys, we could see this market get really ugly, meaning the stock market. And it's surprising to say, but I'm just going to pull this up very quickly. Apple is one of the primary targets that I have for a short. I've been talking about this 158, 159 level with the room, and I want to actually pull this up. But I do a weekly watch list that I send out. I don't know where. I honestly don't even know where it goes. I think it's for the ads that we have. But I actually talk about this and talk about the breakdown because I looked for a buy in Microsoft. Well, that was blown out of the water. There's no way. It didn't hold. It initially held, but it didn't hold. But I talked about the breakdown for Apple. The previous week in this video watch list, I actually talked about Microsoft as a strong short. Let me see if So I actually talked about the same guidance here in terms of looking at Microsoft for a short. This may sound crazy to you, but I think we should short one of the most powerful companies in the world. That company is Microsoft. And you can see those for the week of 9/12. And my breakdown for the chart here was a short right at that key resistance range, right around 267 to 270. Well, obviously it ended up ripping from that level all the way down to the 52-week lows, now making new 52-week lows, which blew out the thesis of being a buyer here. So I actually said I recommended a short. Now I'm seeing the same thing in Apple, guys, that I said potentially a 152, a must short around 158 to 160. And well, currently Apple today hit a high of 158.74 and aftermarket just hit a low of 153. So how far can Apple go? If you're wondering why we're targeting this price level, this is a pretty mishmash patch of just a congealed level of moving averages, guys, that for me just seem to be a major barrier in the near term. We saw that Apple rejected at the 20 SMA, at the 200 SMA, And the question now is, are they going to start holding on this level and price range where they have held previously, showcased here? But if they happen to break down, they lose that 148s. I mean, Howard, this is the most powerful company in the world, the most, beloved name, but that's now the most shorted stock, right? $18 billion plus, more money short in Apple than Tesla right now. I actually see Apple potentially down to this 134, 135 as a low end, but somewhere between 140 to 135 here in the near term. If it loses through this 152, so be on the watch out for that one. I also want to state, if we're going to talk about the SPY really quickly, we're obviously breaking through key support. We filled out this lower gap. I actually told people to expect a breakdown to 170. And if we lose it, we're in this, Top Gun danger zone. There's a gap fill here at 365, lows of 362. And I almost said, if we don't hit this level and bounce like a trampoline, like our tail is on fire and we just see this jump off, we're going to press and we're going to push. And that really puts us in a very dangerous and ugly level. 357, and we lose 357, folks, on this weekly chart. And I know you look at weekly charts. I see it down to that 320, so that 3,200 to 3,000 level, where I fully expect the market to be very, very demanding on the buy side. So it's a lot to look at. It's a lot to digest. It's probably not. This whole time I thought I'll share my screen. Sorry, I didn't even click it. Let me just do that. Really, that's that danger zone and breakdown to this lower threshold and extreme. And if we look at that daily chart, that's that gap fill that we just filled here, this gray line, and that must bounce zone of 3,700. But if we look at Apple, folks, and we see that Apple push, that was a designated target down to that downside level here that I was talking about. And if I just could quickly show, you could see where I had said this space sounds crazy for you. That's the week of 9/19, which is this week. I actually have a video breakdown of that. And you could see exactly what I'm targeting. We hit 158.74 and flushed it down. So it's working out so far. And this was the bounce. This was a short that I called in Microsoft for the week prior on the 12th. And it's the same structured and breakdown. And again, Microsoft came down to their 52-week lows here, initially held, and then they just slammed through it. So now Microsoft is in you can see right here, right? This is where we're looking for that reversal up. That little circle was the projected move down to the 52-week lows that I had talked about. Now we're seeing projectable downside as low as 220 to 212 in the near term. I mean, Howard, what's going to happen if names like Microsoft and Apple can't hold ground? Those would be kind of looked at like how you would look at BTC. If BTC goes down, it drags a lot of stuff with it. I'm a bit nervous, Howard. I don't think you're as nervous as I am because your markets are holding up better, but I'm just going to be fully transparent, guys. I'm really nervous that we're going to see new 52-week lows here. I don't know, Howard. I know you don't really overly pay too much attention to stocks, but as an outsider perspective, I mean, do you kind of see this? Are you a bit nervous about the stock market as well?
Yeah, I mean, I mean, I'm bearish in general on all the markets through the midterm elections. I don't think that they have much, direction right now. Macro events keep on just adding more headwinds to each thing. People are getting more and more nervous. Inflation's hitting, harder and harder. It's going to continue to. Yeah, I mean, I see it. I'm completely risk off in stocks right now. I don't.
I'm just curious. You're a little bit more sensitive to seeing inflation because of your ties to the service industry, right? And I personally said to my room, I told them that it sounds pompous as hell, but I haven't seen the effects outside of fuel and food, which is what's expected. The only place that I've truly seen inflation take hold, and again, this is going to sound pompous, my man, is when I go golfing. For some reason, tee times, which I used to be able to buy at like $40, $50 for Sunday, let's say like 11 o'clock a.m. tea time, they're going for 100 to 120 now. And I had this discussion in my room, and it turns out it could possibly be because fertilizer costs are way up, fuel costs to take care of the actual course, water costs are going up, and then the actual effect of the dollar is being weighted. And it sounds, like I said, it sounds so pompous that I'm referencing Gulf tea times as where I'm seeing the biggest case for inflation. I mean, do you feel like we're on the verge and the cusp of it really getting out of control, like spiraling out of control, so to speak?
I mean, there's a couple of things there. As long as employment stays high, then that mitigates some of the issues. Usually in most of the downturns, we have a high unemployment rate, which exacerbates the problem for the lower class even more. So I don't know that you're going to see that. I mean, I don't know about golf courses. They haven't really gone up over here much. I think that's tends to be also supply and demand. Bottom line is, I don't know how many courses you have that are good or comparable to what you play and what that does to the price of golf. But yeah, I mean, it would make sense, just like anything else. They're trying to recover, and especially coming out of COVID, where that stuff was sort of, golf was always sort of there, even during COVID, except for that first, even after like the first few months, they pretty much, that was the one thing you could do. So I don't know, I can tell you that, if you look at hotel rates, if you look at travel costs, airline costs for airline tickets, even, those things have all gone up, inflation.
But they're coming back down now.
Well, that's because now demand has gone way down. So now the people aren't traveling, especially if you get international. But they're still not down to the levels that they normally are. They were much elevated, especially hotel rooms, very elevated. If you look at hotel rooms, even throughout the winter at most, resort spaces, that would be the inflation that you're talking about. Restaurant inflation is already there. Food inflation's there, but I don't buy much else. I mean, I don't, so I haven't looked at electronics or anything like that. And there, what you've run into is that, there's pent up supply because they all got nervous because everybody bought a TV in COVID. So they thought that was going to continue to happen.
And a PC.
Right. So they all stocked up those things and now they have too many. So that's where you get oversupply of stuff. But, the things that people care about the most, like you said, are food and gas. I mean, that's, for most people, that's the biggest expenses they have. And then rent, you don't rent. As the, one thing that they're hoping is that will go down. That's one of the bigger inflation parts of the core inflation, I guess, is rents.
Redfin reported today that rent is up nationwide 11% year over year, I think. I believe they said nationwide.
That's a big inflation. You know what I mean? Is 11%. If you were paying $1,000, you're paying $1,100. That's a lot for a lot of people. So, again, it hits different people differently. But you add that in. If you got to buy a car right now, it's very, very expensive. People are paying well over MSRP to get a car.
Crazy, by the way.
That's what I mean is, while you said the only thing you really see is in golf is as we start to talk through it, it's, it's in a lot of these different areas, that it's done. But the only thing I've seen huge discounts, cruises. If you want to go on a cruise, they're very inexpensive.
Yeah, you and I talked about that too.
Yeah, there I definitely see it. Airlines, they've had some specials, but overall airlines, depending on where, if you're trying to go anytime, even close to prime time, you're screwed. I was looking at stuff for Christmas and all that. They're definitely done. And I was looking at like going to ski spots and stuff, during the winter. It's definitely expensive. So those are the main things. I haven't looked at renting a car yet, but I would assume that that's up there too.
It's nowhere near where it was. I mean, it was crazy. I believe that when I went to Hawaii this year, thank God, Howard, that my wife was hawking it. We ended up renting 8 days. It was, I think it came out to $480, which is actually pretty cheap overall. My friend went to Hawaii a week later, didn't think forward, decided to rent a car, and they were asking for upwards of $800 a day to rent a car because of the demand.
That's crazy.
It was so nuts. And he's like, what is this? What are you, $800? And I thought it was crazy. And then he started showing me these screenshots. And I was like, I don't know what to tell you. This is what I paid.
Yeah, I mean,
this is what I paid.
The right time is correct. Hawaii is also a little tough because of the island situation. Of
course. But I mean, the demand for rental cars was up everywhere.
I looked in Savannah, Georgia, down into Key West, down to New Orleans, down to Nashville for like into the Christmas time, and every hotel room is extremely expensive. You're lucky to find anything under $250 at all, per night. And that's, those are high rates. Those aren't, they're not talking New York City. I do think travel is coming back up in general. And we'll see. Yeah. I mean, I've said it. I think that we're in for worse food shortages and other issues that are going to hit us that people don't realize. Flour was the one they were talking about today on CNBC, that flour costs are going way up. So, yeah.
Agricultural costs. Yeah. They all kind of spiked up, and like crude's kind of spiked, and like we saw potash names kind of move up. Uranium names are on watch, all because of the Putin announcement about remobilization. He didn't declare a war per se, but he's obviously calling for reserves to come back and become soldiers, and they're going to dedicate more government money towards military spending, either to resupply or to whatever the case may be. Listen, he's clearly feeling the effects of not being as successful as quickly as what he was anticipating, but
that's for sure.
We'll see. Yeah, we'll see how that all plays out. It was good to get your thoughts on everything, Howard. It's always interesting to kind of get someone who isn't that closely tied to the markets, even though you still watch it every day. Your perspective, and then of course what I guess you would say is the quote unquote professional. Which am I a professional? Look at my shirt. Look at my hat. I got a brewery hat on. But, obviously this is my livelihood. This is everything that I do in terms of my perspective. So hopefully, folks, this helps you out. This gives you a little bit of guidance. And of course, we'll be back next Wednesday with another episode of Dips to Rips. Today, folks, if you happen to like what you hear, do me a favor, comment, like, subscribe, share with your fellow friends. We plan on having a guest on here soon enough. We're going to jazz it up a bit. And ladies and gentlemen, if we could get your support, we would greatly appreciate it. In fact, there may be a giveaway, small giveaway, coming up soon for our listeners. I'm pretty excited about that prospect. Awesome. Ladies and gentlemen, I just want to say thank you for your time. Peace and love. On behalf of the great Howard Greenberg and myself, we want to say we're out.
Have a great week, everybody.
Next week.
This has been Dips to Rips with Howard Greenberg and Charlie Moon, brought to you by Prosper Trading Academy. Visit us at prospertrading.com to find out more. This podcast should not be considered professional, financial, and/or investment advice. By accessing this podcast, you acknowledge that Prosper Trading Academy LLC, PTA, makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information and opinions presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. PTA does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. The third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of the PTA. PTA assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials of the third-party sites referenced in this podcast, or the compliance with applicable laws of such materials and/or links referenced herein. Moreover, PTA makes no warranty that this podcast or server that it makes it available is free of viruses, worms, or other elements of codes that manifest contaminating or destructive properties. PTA expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use this podcast or the information presented in this podcast.